I have the right to buy NJ Limited shares for 1000 rupees. Can you believe it? So why is everyone laughing at me? What did I do?
If you are keen on understanding what are derivatives, what are financial markets is the fundamental question over here. So from the past till now, what has happened is the trend. And from now, what will happen in future is your expectation. Selling means closing the long position. Selling does not mean initiating a short position. That is why the terminology used over here, you should be careful. We don't call it sell, we call it sell short or short sell. So short sell indicates selling something that you don't have and you are going to buy it later to cover up your position, and that is why when you reach the target, you don't call it buy, you call it buy to cover. Now let me remind you something very important. If you are new to this channel, then please find the title of this channel on YouTube, and my humble request that you please subscribe to this channel. This channel is specifically designed and placed on YouTube for the benefit of CA, CFA and CMA students. Hello everyone and welcome back to the world of finance. Now in this class we are going to get started with a very important segment in your curriculum titled as derivatives. Now if you are keen on understanding what are derivatives and what are derivative markets, it is essential for you to first understand what are financial markets and how financial markets are classified, because derivative markets are components of financial markets. So the biggest form of markets that you could ever imagine are financial markets. Now, what are financial markets is the fundamental question over here. Let us first try to understand this question and how to answer this. What are financial markets? I would say financial markets are platforms where various entities, including individuals, business entities, companies, governments, they trade financial assets. Assets may include stocks, bonds, other securities, currencies and even commodities and even derivative instruments. So where all these instruments are traded, these are financial markets. Why financial markets exist and what function a financial market would perform other than providing a platform to trade? One important feature could be price discovery and information that can be generated. So all components of financial markets, they will help these individuals and business entities and governments to get the price discovery of various assets, and not just the price discovery, other information pertaining to all these financial assets and securities and commodities will be considered as components of financial markets. So once you have understood what are financial markets, we will then move on to understand the classification of financial markets. So based on what we have just discussed, financial markets are platforms where individuals, business entities, companies and governments trade financial assets like stocks, bonds, currencies, derivatives and commodities, facilitating the flow of funds, investment and price discovery. Alright, so now let us talk about the classification of financial markets. Now there can be different ways in which you can classify financial markets. You can classify financial markets into primary and secondary. You may classify financial markets based on what products are being traded, and there can be various classifications and sub-classifications. Therefore, it is very important to understand the entire hierarchy that I am explaining over here. So, financial markets can be best classified by the type of components that are dealt with within financial markets, and that way we have four types of categories within financial markets. One is money market, another is capital market, yet another is forex market, and the last one could be commodity market. So right now the discussion that we are having need not focus on the forex market and commodity market. So let us fully focus on the money market and capital market. Now, money market and capital market both deal in financial securities. Now, these financial securities could be classified as short term or long term, where the time criteria would be under 12 months or up to 12 months can be considered as short term, and anything above 12 months can be considered long term. So, if it is short term securities, the sources and application, or you can say the arrangement of funds and investments for a short term basis will be covered under money market, and the long term funds will be covered under capital market. The term capital itself indicates something which is long term. So, long term deals with capital market, and capital market will be comprising of various long term securities. So, here if you talk about the capital market classification, it can further be classified into debt market and stock market. So, debt market, what we generally refer to as all the fixed income securities like bonds and debentures, they are dealt with in debt market, whereas the stock market deals with stocks. Now, as I told you, markets can be classified as primary and secondary market. So, let us first understand what are primary and secondary markets. Focusing on the stock market, when we try to classify the stock markets into primary and secondary markets, what we will experience is primary market is the market where a company will be issuing securities and the buyer of these securities will be subscribing for these securities to the company directly. In other words, you can take example of an IPO. So, an IPO transaction is basically a primary market transaction. That means within a primary market, the company will be issuing securities and whoever wants to invest will be investing in these securities. That is a trade between the issuer of the security and the investor. Now, that is the primary market transaction. But after an IPO, the already floated shares will be traded amongst the investors. That means there will be continuous buying and selling of shares happening, and that buying and selling of shares happens in secondary market. So, we have classified stock markets into primary and secondary, and same way you can also classify the money market and debt market also into primary and secondary. So, you can have the classification of debt market also as primary and secondary. So, in a debt market, when classified as primary and secondary, the company which is issuing bonds will be issuing in the primary market. When it is repaying the bonds, it will repay in the primary market. Whereas, when the issued bonds are traded amongst the investors, that is, investors keep buying and selling bonds amongst themselves, that will be a transaction of secondary market. Now, right now again, our focus point is not the debt market. Our focus point is clearly the stock market. So, let us completely focus on stock markets, and here we would try to split the stock market into primary and secondary. And what is primary and secondary, I have already explained to you. If I focus on the secondary market within stock markets, it can be classified into spot market, which can also be called as cash market, and the other segment will be the derivative market. So, spot market also known as cash market, derivative market also known as F&O market. F&O market, basically F and O representing futures and options. So, within derivative markets you will be finding the further classification as two important instruments type, that is futures and options. Now, what are futures and what are options, and everything in detail about futures and options you are going to explore in detail when we are dealing with the derivative subject matter as such. Now, within futures and options there can be different types of futures and options contract. There may be stock futures, there may be index futures, there may be currency futures. Likewise, within options also there can be stock options, index options, and even currency options. So, all these are basically the classification of financial markets. So, what I would want you all to do is just pay a focus on this particular screen and possibly note down the whole content. Now, an important matter to be discussed, that is about the classification of secondary market into spot market and derivative market. So many students keep asking me, sir, what exactly is the difference between these? Now see, spot market is meant for spot transactions. So in the stock market, within the secondary market, when you want to buy or sell the stock immediately, that means you want to buy the stock of a company right now, you want to sell the stock of a company right now. For immediate buying and selling of stocks, you go to the spot market, that is also known as cash market. However, if you enter into a contract to buy or sell a stock but not immediately but at a later date, then what is the relevance of current date? At the present date, you agree upon the price. For example, you agree to buy a particular stock at a future date and you want to fix the price at which you will be buying today itself. So you are fixing the price today, but the settlement will happen later on. Then it is a derivative market transaction. So the secondary market, when split into spot market and derivative market, spot market is meant for immediate spot transactions and derivative market is meant for the transactions or the settlements that will happen in future, only the price is fixed today. So that was all about the financial market classification. Alright, now you are geared up to get started with the understanding of derivative. In simple words, we are going to define derivatives, and what I am going to do, I will be breaking the definition of derivative into three important pointers. Point number one, derivative is a contract between two parties expected to be settled at a future date. So what does that point mention? Derivative is a contract. That means without a contract, derivative cannot emerge. So derivative is a contract between two parties expected to be settled at a future date. Now this is one of the very important characteristic of derivative, that it is entered into now but it is expected to be settled at a future date. The second point is the most crucial in the definition of derivative. It says it derives its value from the value of the underlying assets or components. Now this line, it needs real understanding, as in what exactly it is trying to convey. The term derivative has originated from this characteristic of this derivative contract, that it derives its value from the value of the underlying. So like any other contract, a derivative is also a contract. If a written contract, it would be, say, in a piece of paper. That piece of paper does not have any worth of its own. So there will always be an underlying asset or an underlying component to that derivative contract, and this contract will derive its value from the value of that underlying, or we can say from the price movement of that underlying, the derivative contract will derive its value. So it derives its value from the underlying assets or components, or you can say from the price movement of such underlying assets or components. Now the moment I read this line, students get confused that what is this term underlying asset or underlying component. See, it is basically a contract to buy or sell something. It could be a contract to buy or sell a share. It could be a contract to buy or sell a currency. It could be a contract to buy or sell a commodity. It could be a contract to buy or sell any product, anything. Whatever be that commodity, whatever be that currency or stock or security, which is the subject matter of the contract. That means a contract has been designed to buy or sell such asset. In that case, such asset is called underlying asset. For example, if I am entering into a derivative contract to buy the shares of X Limited, then shares of X Limited becomes the underlying asset. So the derivative contract will never have value of its own. it will derive the value from the price movement of the share of X Limited. Now what I am going to do after a while, I am going to take up an example to illustrate this particular characteristic of derivative, that it derives its value from the value of the underlying. Now third crucial point in the definition of derivative, either no initial investment or a very small amount of initial investment is required. So for example, you expect price of a particular share to rise in the future and you want to take advantage of that. Suppose the price of that share right now is rupees 400. So what you can do is you can buy the share for rupees 400 by investing rupees 400 actually, and then wait for the price to rise. When it rises, you sell it. So the amount of money that you have invested was the entire value of the share. However, if you do not buy the share in the spot market, but you enter into a derivative contract where you agree to buy the same share at a future date at the price which is agreed today, then you don't have to pay the entire price of the share today. You may or may not have to pay anything depending upon the terms of the contract. So you may not be paying the entire amount definitely. Say a fraction of the amount you will have to pay as initial investment. So the amount of initial investment can either be zero or a very small amount compared to the price of the asset. This is what we call as derivative. So if I have to summarize this definition, I would say a derivative is a contract between two parties expected to be settled at a future date. It derives its value from the value of the underlying assets or components, and either no initial investment or a very small amount of initial investment is required. So I'll give you a minute, quickly take note of this definition. Now let us consider an example to exactly understand how a derivative derives its value from the value or from the price movement of the underlying. So please take note of this example in your notebooks. You want to acquire 500 equity shares in NJ Limited. Each equity share is presently quoted at rupees 1000. You enter into a contract under which after 3 months you can buy 500 equity shares in NJ Limited at rupees 1000 each. The contract gives you the right to buy 500 equity shares. What is most important thing in this example, the contract gives you the right to buy 500 equity shares, not today but after 3 months, and the price is stated at rupees 1000. Now just imagine when you get a right, correct, when you get a right but not an obligation to do something. So you just have a right in this contract, you do not have an obligation. Now for your understanding at this stage, I will say that there are various types of derivative instruments or derivative contracts. A contract that conveys only the right but not any obligation, like this, it is referred to as option contract. So these types of derivatives are referred to as options. So when you have a right or when you have an option to buy, you will buy it only when it is beneficial for you. So sometimes what happens when I give this kind of right, so NJ Limited happens to be my company, and if I have conveyed this right to someone, that person sometimes gets too excited about that, and let us see what happens in such excitement.
Yeah! I have the right to buy NJ Limited shares for 1000 rupees. Can you believe it?
So why is everyone laughing at me? What did I do?
Well, the obvious reason people are laughing at you is the simple fact that presently these shares are already quoted in the market as rupees 1000 per share. Anyone can buy this share at rupees 1000 without having these rights. So you have these rights or you do not have these rights does not matter. That is why people are laughing at you. Now, but that is a scenario at present when your statement is becoming a matter of laughter for people. Now let us do one thing. Let us observe what happens when the underlying asset, that is shares of NJ Limited, when there is a price movement noticed in the shares of NJ Limited over the coming 3 months time. Let us look into what exactly will happen. Keep paying attention on screen and I'll show you something important over here. The story starts with the scene where the person says, I am interested in buying shares in NJ Limited, though not now, after 3 months. So what Mr. NJ has to offer? Mr. NJ says, all right, I give you a right to buy 500 shares at rupees 1000 each after 3 months. Here you go. And there is a contract that is signed and handed over to the buyer. Now this contract is what we call as a derivative. It offers an option to buy the shares at rupees 1000. Now the fact is, these shares are presently priced at rupees 1000, correct? If presently the shares of NJ Limited are priced at rupees 1000, what happens to this contract? This contract is simply worthless. But what will happen at later stage? Let us try to observe. If after 3 months the price of these shares turn to be rupees 1250, now here comes the catch. So the market price of the share is rupees 1250, but because of this contract that this person is holding, he can buy the shares at rupees 1000, correct? What has the market price of 1250 can be bought at just 1000. That means for every share purchased through this contract, there will be a benefit of 1250 minus 1000, that is rupees 250. And there are 500 such shares underlying the contract. Therefore, 250 multiplied to 500 shares, the total value of the contract becomes rupees 1,25,000. So what was worthless at the beginning now becomes 1,25,000 in its value. Now, if the price can go up in the market, the price can also fall down. So what happens? If the price after 3 months is not 1250 but just rupees 950, in that case the option will be worthless. The option will not be exercised, as it will be better to buy the shares in the open market at 950. Why would you use this right to buy the share at 1000 when in the market it is priced at rupees 950? Again, what we see, the contract becomes worthless. So keep in mind one thing, what is changing in the value of this contract, what is bringing the change in the value of the contract is the price movement of these shares, which we are referring to as underlying assets. So keep in mind one thing, this contract is a derivative and it derives its value from the movement in the price of the share, which is the underlying asset in this example. So what do we exactly conclude from this example? 4 conclusions can be drawn from this example. Number 1, the contract is a derivative instrument. It fulfills all the conditions of a derivative. It gives you the right to buy the shares. The underlying asset is the equity shares in NJ Limited. And lastly, the value of the contract changes with the changes in the price of the equity share. It derives its value from the price movement of the underlying. Now there is no need to write up this content. This is very easily concluded and drawn from this example what we have just covered. Now in this example what we have just discussed, the underlying was the equity share in NJ Limited, but the underlying asset or the underlying component could be anything. I told you earlier, it could be commodities, it could be currencies, it could be interest rates, it could be any consumer price index or even stock market index. Anything can be the underlying. That is why we use the term underlying asset or an underlying component. Most textbooks just use underlying assets, but I would prefer saying underlying component because, for example, if the underlying is an interest rate where the whole subject matter of interest rate derivatives come into picture, we cannot call an interest rate as an asset. So we better call interest rate as one of the component which is the underlying for a derivative contract, and then such contract becomes interest rate derivative. If the underlying is the currency, it becomes a currency derivative. If the underlying is an index, it may become an index future or index option. Now, as I told you, this is a big, huge topic and we are going to gradually move ahead. So, making sure that you understand this point, that the underlying component could be any. And again, I don't want you to write down this, just have a glance at that. We say, while in the example given above, the underlying asset was equity shares, in the derivative market, the underlying asset or the underlying component could be currencies, commodities, precious metals, interest rate, market indexes, inflation or consumer price indexes, etc. Now let us move on to an important discussion about functions of derivatives. The first thing, financial derivatives help in facing financial risk arising due to changes in prices, interest rates and currency rates. Now this is something crucial. Why someone would want to enter into a derivative contract? What could be the reason? There can be three typical reasons why someone would be interested in entering into a derivative contract. One could be protection against risk. So what happens? There will always be uncertainty in terms of the prices that may prevail in future, and uncertainty brings along risk. Now, risk is something that cannot be eliminated from the scene. Risk will exist, but there are ways in which you can manage the risk, which we call as hedging. So, what happens at a little later stage, I am going to give you examples through which you can understand that how can one take a complete risk-free kind of scenario by entering into a derivative contract. In other words, whatever risk is existing by holding an asset or any position in the market, it can be hedged through a derivative, where derivative can provide a guarantee towards the price movement. In other words, I would say you can freeze a price, and irrespective of any other price prevailing in the market, you can settle your trade at the specified price. That gives you the protection. And as I told you, you can better understand this by examples. So once you freeze a contract by entering into a derivative, you will find that there will be absolutely no risk that you will be having until the period which is covered within the derivative contract. As a simple example, suppose someone has acquired an equity share in a company and the purchase price was say rupees 500. Obviously, why someone would acquire a share? So somebody is investing in a share primarily because the investor believes that the price is now expected to move up. So on a long run, price moves up. That is what the expectation is. However, in a temporary scenario, we can even expect a decline. So when there is an expected decline, it will bring risk because the wealth simply deteriorates, because the investment what you have made is having a decline in the value, the wealth deteriorates. If the wealth is reducing, this is a risk. Now what happens? A reduction in the value cannot be foreseen as a permanent reduction or a long-term reduction. If that is the case, you better sell off your share immediately, or don't invest into such shares where there is only decline possible. What I am trying to tell you is, if there is a temporary decline, it can be hedged through derivatives. So you enter into a forward contract or a futures contract to protect the adverse price movement. Let me give you a simple example of a forward contract. So I have suppose purchased a share at rupees 500 and I am expecting a decline in the coming 3 months time. I enter into a forward contract to sell the share at 500 irrespective of the prevailing market price, and the settlement will happen after 3 months from now. So after 3 months, if the share price goes down to 480, 470, 460, 450, any price, but I will still be eligible to sell it at 500 because that is a contract that I have entered into. The counterparty, who will be the buyer, will be under commitment to buy that from me at rupees 500. This is a forward contract example. So entering into a forward contract or a better version of forward contract, I would say a futures contract, will give you complete protection against the adverse price movement, and that is where the term hedging comes into picture. So I'm going to explain hedging and all the other aspects in detail at later stages within this chapter. Right now, let us focus on functions of derivatives. So continuing with this list, I would bring forward, connected to the first point is the second point. Such instruments provide a commitment to prices for future date, thereby protect a party against future adverse movements. Financial derivatives also provide opportunities to make profit for those who are ready to bear risk. Now this is a very, very important point again, where one side, derivative contracts can provide protection against risk. Other side, derivatives provide opportunity to those who are willing to take risk, and they can make profit out of that. So let me give you an example. Suppose simply we take an example not from derivatives, but say an insurance contract. Suppose I take an insurance policy against say fire insurance. So I have a warehouse where inventory is lying, and I have taken a fire insurance policy. Now what will happen if there is any fire occurring and it causes damage to my inventory? The insurance company will compensate. That's a contract. So what I have done, I have paid a small amount of insurance premium to take this insurance contract. So I have protected myself. So I am the hedger in this example because I am protecting myself. Who is speculating over here? It is the insurance company which is speculating, because for a small amount of insurance premium, what they would have collected from me, they have given me assurance of a big value, as much as the value that will be lost in case fire occurs. But what they perceive is occurrence of unexpected events like fire could be a rare thing or could be a rare possibility, and they are willing to take chance, they are willing to take that risk for earning that little amount of premium. So you can see one thing, one side where there are hedgers, other side there will be speculators. So who are hedgers? Hedgers are parties who try to protect from risk, and speculators are parties who try to take risk for making some small gains. You know what happens? There is yet a third category of participant in the derivative market known as arbitragers. Now arbitragers don't behave like hedger or speculator. They are completely different. Arbitragers, they keep watching the market and they try to look into the equilibrium pricing. If the price quoted in the market is different from the equilibrium price, they will take advantage of that opportunity, and do you know what? They will make risk-free gains. That means they make gains without taking any risk. Therefore, arbitrage is also one of the very, very important feature of derivative. So we are going to therefore focus on each of these three aspects, that is hedging, speculation and arbitrage, one by one as and when we move ahead. So right now, none of these discussions I am entering into details. This is just an introduction of derivatives that we are having discussed over here. So let me put forward that last point also, what I have just discussed. In the process, derivatives transfer the risk from those who want to avoid it to those who are ready to take the risk. So carefully understand this point, where the message is very clearly conveyed that if there is risk existing in the scenario, you cannot eliminate that risk, but somebody's risk can be taken by some other party. That means risk cannot be avoided on absolute basis. Risk will be there, chances of loss will be there, but if you don't want to take that risk, if you don't want to take that loss, somebody else will take for you. You have to compensate that someone by paying something. So one person is taking the risk which is on the other person. So in the derivative market, you see movement of risk from one party to another party because of formulation and existence of these derivative contracts. I would want you to take note of these important functions of derivatives. Let us move ahead and now talk about the characteristics of derivatives. The transactions in the derivatives are settled by squaring of such transactions in the same underlying. The difference in value of the derivative is settled in cash. Now, this is a very, very important characteristic of derivative, and because of this, lot of other connecting matters will arise ahead. So let us try to understand what exactly is conveyed. Suppose I expect that the price of a particular share is going to increase in the future. Currently its price is rupees 300. I am expecting an increase. So I take a forward contract or a futures contract to buy that share, say at rupees 300, but after 3 months from now. So after 3 months I will buy, but at rupees 300. Now what happens? If I am entering into a contract to buy the share after 3 months at rupees 300, and later on what would happen? Say the price is increased to 320. So do you understand that I have made a gain out of this arrangement, because something whose price prevailing in the market is 320, I have the right to buy that at 300. So I have made a gain of rupees 20. Now what could have happened? Understand this point very well. I would say how I have made a gain of rupees 20, because as per the contract I am eligible to buy at 300, and in the open market the price prevailing is 320. So I can buy at 300 as per the contract and sell it in the market at 320, thereby make a profit of rupees 20 for myself. The counterparty will have to buy the share in the market at 320 and sell it to me at just 300 because of the contract. That party will incur a loss of rupees 20. Now if you go into this actual buying and selling thing, what is the problem? The problem is the whole transaction will bring lots of cost, because when I buy the share I will have to buy it at some brokerage and other charges. Someone who is selling the share will have to sell it again at some charges. So instead of entering into all these charges, why to get involved with so many transactions? Eventually both the parties can settle the accounts by the differences in price. So I have made a gain of rupees 20, counterparty has incurred a loss of rupees 20, that counterparty should simply pay rupees 20 to me, matter gets over. So in a derivative contract, what you will see that the price difference is settled in cash. That means there is no actual buying and selling happening. The price difference is simply settled in cash. So the next point is the connecting point over here. Let me put forward that there is no limit on the number of units transacted in the derivative market, because there is no physical asset to be transacted. Now if you can see, when there is a derivative contract, how many contracts and with how many units of underlying you are entering into, it really does not matter. There cannot be any limit. You can have millions of contracts in derivatives, because in the market there will be no actual buying and selling happening. Because there is no actual buying and selling happening, you can trade into as many contracts and as many number of units you want to. There is absolutely no limit to that. Keep in mind one thing, the derivative market transactions are always squared off by taking the settlement in cash based on the price differences. Actual buying and selling does not happen. So if you actually want to buy the share, what you have to do, you can buy the share in the spot market. Actual buying and selling will not happen in derivative market. The exception to this could be a forward contract, where there is an OTC type of contract between two individuals without involving the derivative market. I'll be explaining that feature when we move further with the forward contracts, and where we talk about the differences between forward contract and futures contract. So let me take the next important point over here. Derivatives are only secondary market securities and cannot help in raising funds to a firm. In fact, derivatives arise only when the shares and other securities are already issued by the companies. A very, very important feature. And in fact, if you can recollect, when we earlier had a discussion about the entire hierarchy and classification of financial markets, do you remember derivative market came under the secondary part of the stock market? Means stock market was divided into primary market and secondary market. Derivatives do not come in primary market, derivatives come in secondary market. Because derivatives come under secondary market, where only trading of already issued securities are carried out, correct? So if a company wants to raise funds by issuing securities, the issued securities will always be issued in the primary market, not in the secondary market. It is the secondary market which includes derivative. As a result, derivatives cannot be used for fundraising, because derivative market is the component of secondary market, whereas fundraising will happen always with the primary market. So let us do one thing, let us quickly take note of these important characteristics and then we move ahead. Let us move ahead and write some more characteristics. That is, the derivatives provide a hedging of price risk of financial transactions over a certain period. Important thing, very, very important thing. This characteristic conveys one thing very clearly. If you take a derivative contract for hedging your position, it cannot give you a complete protection permanently. It will give you only for a certain period. So keep in mind one thing, a derivative contract cannot have an endless life. It will have a specified date of settlement and it will generally be settled in the near future. Say 3 months, 6 months, at the max it could be 1 year, nothing beyond that. And as a result, it is only a certain period for which you get that protection. And another important feature that we have already discussed, it is a contract to be settled in future. And how it will be settled? It will not be settled by actual buying and selling, it will be settled by a cash payment. Cash payment of what? Of the differences in price. Then we have also talked about participants in derivative market. 3 types of participants that we have talked about. And who are those 3? Hedgers, number 1, speculators, number 2, and arbitrators, number 3. Now who are hedgers, who are speculators, who are arbitrators? Just to remind you, hedgers are those who incur some cost to avoid the risk that they have. Speculators are those who are ready to bear the risk for making some small profits, and arbitrators are those who make profits without taking risk. So these 3 types of participants you will generally find in the derivative market. Let us quickly take note of this as well and then we move ahead. Let us write a little more about hedgers and then speculators and then arbitrators. I have already explained it to you, just quickly take note of this. Now important matter that we need to discuss is about the flow of the entire chapter. So basically derivatives are classified into 4 different types: forwards, futures, options and swaps. And at later stage within options and swaps, when you go for combination of options and swaps, you will also come across something called as swaptions, basically combination of options and swaps. But as we have decided to move gradually, now irrespective of what is the content given in your institute's curriculum, I'll be moving in a logical way. That is, I'll be first taking the discussion on forwards and futures, then we will move on with the discussion on options, and finally we will be talking about swaps. So it will be one thing at a time, and because forwards and futures are interrelated, we will begin with that. So I believe while I was talking to you, you would have written this already. That is, 4 types of derivatives are into existence: forwards, futures, options and swaps. Now as I said, we will be beginning with the forwards and futures. What exactly is a forward contract? A forward contract is a contract to buy or sell something at a specified future date. So it is buying or selling a security particularly at a specified date in future. It could be even a commodity getting involved, So if it is a security or commodity or currency, that becomes the underlying, correct? So basically a forward contract is a contract to buy or sell something at a specified future date. Now over here, what is the meaning of forward price or a forward rate? So when we talk about a forward contract and there is a negotiated price, say it is with respect to a share, or negotiated rate with respect to a currency, then what is that forward rate or forward price? Now this is applicable for buying and selling the underlying at the later date or at a future specified date, but the price is agreed now. So important characteristic is forward rate is agreed today and it is applicable for buying and selling the securities or any underlying at the specified future date. I would want you to take note of this quickly and then we move ahead. Let us move on to some important examples. Say there is Mr. A and he conveys, I want to buy 500 shares of X Limited at rupees 560 each after 3 months. And Mr. B on the other side says, I agree to sell 500 shares of X Limited at rupees 560 after 3 months. Say they both enter into the same underlying, that is equity shares of X Limited, and the settlement will happen after 3 months. Mr. A agrees to buy at 560 and Mr. B agrees to sell at 560. Now A says, let's make a deal, let's sign a contract, and they both sign a contract. Now this contract is what we call as a derivative. Now because why it is a derivative? Because it is a contract expected to be settled at a future date. If after 3 months the price of the share of X Limited turns to be rupees 550. Now here you need to understand what is going to happen if the share price in the market turns to be 550. A has agreed to buy and B has agreed to sell at 560, correct? A has agreed to buy at 560, but the prevailing market price is 550. So what happens? A has agreed to buy at a price which is higher than the prevailing market price. So A incurs a loss, so the counterparty B makes a gain. Why B makes a gain? Because B will be selling at 560 something which is having the price of rupees 550 in the market. So let us take a clear understanding about this. Mr. A loses rupees 5,000 and Mr. B gains rupees 5,000. How we get this 5,000 amount? Because per share the amount of gain or loss is rupees 10, that is 560 minus 550, that difference rupees 10 multiplied to the quantity 500 shares. So you need not write all these examples, it is just basically meant for your understanding. Now what would happen if the price of the share turns to be 570? In that case, the opposite scenario will work, that is Mr. A will make a gain and Mr. B loses rupees 5,000. This time we are taking the difference between 570 and 560 multiplied to 500 shares. So we are observing that this contract is deriving its value from the movement in the price of the share, and this contract is not any option contract, this is a forward contract. So what exactly is the difference between option and forward contract? Though we are going to discuss option at a later stage, but just to give you a hint of what could be option contract. In the option contract, there is no commitment. Now you see one thing, in this particular contract that we have just discussed, whether you are making a loss or you are making a gain, you have to settle the contract. In case of option, the holder of the option has the right to decide. If you want to settle, you settle. You don't want to settle, you don't settle. That means, imagine if you have a right to buy a share at 560 and open market price is 550, why will you exercise your right to buy it at 560 when you can buy it at 550 in the open market without any derivative? In that case, you let your right get lapse. You don't exercise your right. However, if the market price goes to 570, then you have the right to buy the share at 560, then you will definitely exercise your right, you will definitely exercise your option and buy the share at the contracted price of 560 and not at the open market price of 570. So the point is what? a forward contract puts a commitment to both the parties to honor. In case of option contract, the party that is the option holder will have a choice, will have a right, not an obligation. Keeping that in mind, that is the major difference between what we see in forward futures one side and options on the other side. Anyway, let us move on with our discussion ahead. So what we have just observed, we are now introducing speculation through derivatives. Now when we talk about speculation through derivatives, there are two important terms that I need to highlight over here: bullish sentiments and bearish sentiments. Now what exactly do we mean by bullish sentiments? See, basically a sentiment in the market means a kind of expectation what someone has. So you would see in stock and derivative market, two terms are most frequently used: bull and bear. Bull, it has a tendency to rise up. Bear has a tendency to bring something down. So what happens when the sentiment of a party is bullish? We understand it this way, that such party has an expectation that the price will rise in future. That means if you have an expectation that the price will rise in future, in the coming future I mean, you have a bullish sentiment. On the other side, if you have an expectation that the price in the coming future will fall down, that means you have a bearish sentiment. Now many students, they ask me, sir, what is the difference between bullish sentiment and bullish trend? Are they same? No, they are not same. Bullish trend means trend is observed from the past till now. So from the past till now, what has happened is the trend, and from now what will happen in future is your expectation. So what has already happened is a trend, and what is expected to happen is your sentiment. So what does a bullish trend mean? If I say a particular stock is indicating a bullish trend, means it is rising in the market. By far it has risen in the market. That is what we call as bullish trend. Bullish sentiment means we believe that the further movement will also be upward. That means it will continue to rise. Then we say bullish sentiment. Maybe a stock has a bullish trend, but now we have bearish sentiment. What does that mean? Bearish sentiment after a bullish trend means the price of the stock has risen by far, bullish trend, but now we are expecting that the price will fall. That means it is a bearish sentiment. So bullish trend can be continued by a bullish sentiment or a bearish sentiment. It depends on how we are perceiving the future price to be, or how we are having expectation towards the future price. And that is where future is filled with uncertainty. So if the stock price has risen by far, a bullish trend, someone may believe that the price will continue to rise, means that person has a bullish sentiment, would want to buy such stock, and someone having the opposite view, that is a bearish sentiment, would want to sell the stock. So that is why buyers and sellers come in the market to negotiate. Understand one thing: if something is reasonable to buy at a given price for someone, other party on the same hand is finding it reasonable to sell at that price. That is where this is happening, because of difference in sentiment. So let us note down the meaning of bullish sentiment and bearish sentiment. Bullish sentiment means expectation that the price will rise. Bearish sentiment means expectation that the price will fall. Well, I am very sure that you have already written this heading in your notebooks as speculation through derivatives. Now under this, let us take an example to understand. Mr. A stating that X Limited's share quoted rupees 560 now, after 3 months the price will rise. So we can conclude that Mr. A has bullish sentiments. On the other side, Mr. B says no chance, after 3 months the price will fall. That means Mr. B has bearish sentiments. So when the parties have opposite sentiments, they may have a chance of entering into a trade or entering into a contract of derivative. Both of them are observing that the current price is 560. A believes that the price will rise, B believes that the price will fall. So at 560, A may be interested to buy because At 560 if he is buying, where the expectation is the price will rise, it will be benefiting Mr. A. Whereas Mr. B believes that the price will fall and he is willing to sell at 560, when the price would have fallen down, B will also make profit. Now both A and B believe that they will be making profit, that is why they enter into a contract. But in reality, any one will make profit and the other party will incur an equivalent or same amount of loss. So let us continue with the same example ahead. So with this scenario, Mr. A further says, I agree to buy 500 shares of X Limited at rupees 560 each after 3 months. B says, I agree to sell 500 shares of X Limited at rupees 560 after 3 months. A says, let's make a deal, that is a speculative deal. Let's sign a contract. And B confirms that we shall square up the price difference in cash. That means both of these agree that they don't want to actually buy and sell. This is a speculative deal, and purely following the characteristic of derivatives, they don't want to actually buy and sell. They want to negotiate the contract in a way that they will settle the price differences in cash by end of the period. This is how they have entered into a speculative deal. Continuing with this example, we find that they both have signed a contract, and this contract is again nothing but a derivative, because after 3 months, if the price of the share of X Limited turns to be 550, Mr. A loses rupees 5,000 and Mr. B gains rupees 5,000. How we got this difference? I have already explained to you earlier that 560 minus 550 multiplied by 500 shares will give you that difference. Now, important thing over here. It is very important for you to understand who is losing, who is gaining, and why that gain or loss is happening. In this example, Mr. A is losing. Why? Mr. A had bullish sentiment. He expected that the price will rise. So he agreed to buy at 560, but price actually did not rise. Price fell down to 550. So some share whose price is 550, A has agreed to buy the same at 560, that is by paying 10 rupees extra per share multiplied by 500 shares. That is why A has incurred a loss of 5,000. 500 shares multiplied by a differential of rupees 10. Rupees 5,000 is the loss incurred by A. Why did B make a gain? B had bearish sentiment. He believed that the price will fall, and actually the price has fallen down. If the price has fallen down from 560 to 550, B has made a gain because B has agreed to sell at 560. In spite of the price being 550, if he is selling at 560, he'll be making a profit or a gain of rupees 10 per share multiplied by 500 shares. Total gain made by B will be rupees 5,000. Now, because this was a speculative deal, at the end they both have decided to square off the deal by settlement in cash. And what amount they will settle in cash? That will be rupees 5,000. So logically, A should pay to B rupees 5,000, correct? So A has incurred a loss, B has made a profit. So we will say Mr. A should pay rupees 5,000 to Mr. B, and therefore Mr. B starts making the claim. Come on, clear off your due, simply pay rupees 5,000. Mr. A denies. Do you really think so? Forget it. Now this is something absurd. What do we find over here? A party is denying the settlement in the contract. Can this happen in real life? Yes, it can happen in real life. So it's basically a contract. If somebody is denying to settle the contract, you can definitely approach the court of law. But who is going to do all that for 5,000 rupees, correct? Filing a legal suit doesn't make any sense over here. So do you think something is faulty in this whole arrangement? What is something faulty in this whole arrangement? There was no guarantee of performance. This is the big lacuna in this contract. This is a big drawback or shortcoming in this particular contract, where we find that there is no guarantee of performance. A party may simply deny the settlement. If a party is able to deny the settlement, means the contract itself had the drawback. Now, how to overcome this? this is something interesting, right? How to overcome this kind of problem. So let us scrap it out, and a better way to deal with defaults like this: before signing up the contract, what you should have done, you should have involved Mr. NJ, who is an intermediary, and Mr. NJ is asking, wait, before you sign the contract, both of you deposit with me rupees 20,000 each. Mr. NJ, who is an intermediary, is demanding a deposit by both the parties. That means both the parties should make a deposit. So both of them have made deposits of rupees 20,000 each, and Mr. NJ, who is an intermediary, confirms, now both of yours deposits are with me. So Mr. A's balance is rupees 20,000, Mr. B's balance is rupees 20,000. This has already happened on signing up of the contract. Now let us see what happens after 3 months. Mr. A loses 5,000, Mr. B gains rupees 5,000. How we computed 5,000 we have already seen. So logically Mr. A should pay rupees 5,000 to Mr. B. This should have happened. Now what is going to be the difference over here? Keep in mind one thing: Mr. NJ got involved as an intermediary in between the two of them, and what Mr. NJ has done, he has accepted a deposit from both the parties. Now A has incurred a loss, B has made a gain. So what Mr. NJ will do, from Mr. A's deposit he will deduct rupees 5,000, and that 5,000 will be added to the margin or to the amount deposited by B. So when the contract is settled, A will get back rupees 15,000 only, that is 20,000 minus 5,000, and B will get 20,000 plus 5,000, that is 25,000 as the return of the deposit. So please understand this as well. So what happens, from Mr. A's balance, the intermediary will subtract rupees 5,000, and the revised balance of Mr. A will be rupees 15,000. On the other side, that 5,000 will be added to the amount deposited by Mr. B. Now this is how an intermediary plays a dynamic role in this kind of speculative contracts. So now the basic question that arises is, from where to get this kind of intermediary, correct? But that is not a problem at all, because derivative markets act as intermediaries. These derivative markets, they get involved in these kind of transactions, and they provide a guarantee of performance. So when we started this example, we started with a forward contract example. The moment we find involvement of an intermediary with some additional characteristics, it just transforms a forward contract into a futures contract. So if you have understood forward contract, more or less you have also understood futures contract. There will be typical differences. We are going to talk about all these differences at length, but basically there may be two types of derivative contracts. One that we classify as OTC, over the counter. What does that mean? Two parties sitting across the counter and they contract with each other. This is basically over the counter type of contract, OTC. Whereas the exchange regulated contract or exchange traded contract is the contract where all the parties get involved within the exchange. That means the transaction happening through, or the contract that comes into existence through the derivative market, is what we call as exchange traded contract. So over the counter type and exchange traded contract, two different types. So forwards come in the category of over the counter, whereas futures come in the category of exchange traded contracts. So depositing of margins may or may not happen in case of forward contract, but depositing margins will be a mandate in futures. Then how much quantity should be the quantity of the underlying, at what price the buyer and seller are negotiating, everything can be customized when it is a forward contract. In case of futures contract, you cannot customize all these. In case of futures contract, everything will be standardized. So the security that you are entering into the contract for, the quantity, the price, everything is standardized. You just have to take a position, either a long position or short position. Long and short position, what these exactly mean, I'm going to discuss that in some time. Just for your quick understanding, a long position indicates a position of buying and a short position indicates a position of selling. So these are the typical aspects. When you find that these features added with a forward contract, it transforms into a futures contract. So let us look into these important aspects as well. So we would say, for a variety of reasons, future contracts stand superior to forward contracts. So what are future contracts? A futures contract is a standardized contract between two parties where one of the parties commits to sell and the other commits to buy a specified quantity of a specified asset at an agreed price on a given date in the future. We would further write, there are three main features of a futures contract. Number one, the contract is standardized with respect to quantity, date and price. We have already talked about this. Second point, very important point, the clearing house has a key role in trading of futures contract because it guarantees the performance. Let me highlight this particular point. See, involvement of an intermediary. So within the derivative market, the clearing house performs this particular function of settlement of margins on daily basis. That means on day-to-day basis, whatever be the price movement of the underlying component, based on that, from the party taking long and short positions, the margins deposited by them will be having those changes on daily basis. This is what we call as mark to market margins. So this mark to market, MTM, is basically reflecting the position of the derivative contract because of the change in the price of the underlying. So these margin balances are regulated on daily basis, and as and when required, the margin calls can be made. What exactly is meant by margin calls? Imagine a party has deposited some margin and continuously incurring losses. So the derivative market will be demanding that you need to deposit some additional margin to cover up these accumulated losses. So if the margin call is not attended to, the contract comes to a close, and this could be a further loss making situation for the party getting involved, which is incurring losses. So therefore you have to be very careful when you are dealing with derivatives. That is why knowledge of derivatives you have and you trade in derivatives is a different thing. Without the knowledge of derivatives, you directly start trading into derivatives, it could be a big risk for you. So take these matters into consideration. So let us write even one additional point with respect to this margin part. The exchange or derivative market would require the parties to maintain a deposit or margin with it. The margin amount changes with the changes in the daily prices, that is the daily price of the underlying. In effect, profits and losses are settled on day-to-day basis. So a futures contract simply upgrades a forward contract into a secured, riskless, marketable instrument. Now why it is secured, why it is riskless, and why it is marketable instrument, I am going to highlight that feature in a while when I start distinguishing between forwards and futures in detail. So let us move on and start discussing about the differences between forwards and futures. So the first point of difference, forward contracts are OTC, that is over the counter type, whereas futures contract are exchange regulated. You can call it exchange regulated or exchange traded. I have already discussed this point, so I don't have to explain anything over here. Futures contracts are standardized with respect to price, quantity and date of settlement. Forward contract can be customized contracts as required by the parties to the contract. Then futures contract are marketable instruments, forward contracts are not. So it is basically the third point where I need to bring some explanation into picture. One by one, if we discuss. So forward contracts are OTC type, futures contracts are exchange traded. So exchange gets involved in futures contract, exchange has no involvement in the forward contract. One thing clear. Second thing, what we have talked about, if you want the deal exactly your way, then it has to be a customized contract. Futures market or derivative market is not going to allow you to customize your contract as per your requirement. There will be a standardized contract. For example, if there is a particular stock which is traded in the futures market, for example, say shares of Tata Motors. So shares of Tata Motors will be having listing in the futures contract, and you can take a position in the futures contract of such share. So what will be the date of settlement? It is pre-decided. What will be the quantity of share underlying each contract will be pre-decided. What is the price at which you can take long or short position? That will be pre-decided. Everything is pre-decided. The only thing that you can choose is to either take a long position, that is become a position holder of a buyer, or take a short position, that is you take the position of a seller. Only that much customization, or I would say only that much choice the traders can have in futures market. So futures market, the futures contracts are always standardized with respect to quantity, price and date of settlement. Now, the very important difference is this third point, why futures contracts are marketable. In this point, I want every one of you to listen to this very clearly and understand it, because this has a lot of implications ahead. Now see, if you enter into a forward contract with a party, then it is a contract that will bind you till the end, till settlement is done, and only you can settle the contract. Nobody else can take your place, because someone made a contract with you in particular. Now what happens in case of futures contract? Suppose you decide to take a long position, that is the position of a buyer, then who is taking the short position you don't even know. You don't know the counterparty at all. It is the exchange that knows who is the counterparty to which contract, that's all. You have no idea. So you simply took a long position. One fine day you decide that contract expiry is still after 2 months, that means a settlement will happen after 2 months. I have already made the targeted gain. Now I don't think it will be any meaningful for me to stay in the contract. I would want to move out of the contract. So you can sell your contract to somebody else. Any person now willing to take a long position will now take that contract from you. And again, you don't know who is taking that position from you. Please understand this particular aspect very carefully, and I am therefore explaining with an example. Try to follow this. Suppose I have a bullish sentiment about a particular stock. So I take a buyer's position or a long position in the futures contract of that particular share. And I am expecting a rise in price by almost 15% in 3 months' time. But what has been experienced after I have entered into the contract? I have experienced a 5% rise in 1 month itself. Now I don't have the same sentiment ahead. Now I believe that the price may start falling, and what I have gained might be lost if I continue to stay in the contract. Now I feel like I want to move out of this contract. Understand this point. So let's say I have taken a long position, that is the position of a buyer, and you have taken a short position, the position of the seller. So initially when this contract was originated, I was the one holding long position, you were the one holding short position. Today I want to move out of the contract, you stay at your position, you don't even know what is happening at the counter side. Now another person who is willing to take long position will simply demand a long position in the derivative market, and I have asked for moving my position out of this contract. So my position will be handed over to that other party. As simple as that. Whatever margin the other party deposits, that much margin I'll be getting back. So it is obvious that based on mark to market margins, the price of the futures contract will be settled on daily basis, and at any point, whatever be the new price, I am selling my contract, somebody else will buy. So basically I have squared off my position before even the settlement date has arrived, and somebody else has taken that new position in place of me. This is how a futures contract can become a marketable instrument. The day you want to buy it, you can buy it. The day you want to sell it, you can sell it. The day you want to square off your position, contract doesn't get settled, but your position you can square off by making an exit anytime. So entry and exit can happen at any time from the initiation stage till the settlement stage. And even on the last day when the contract is about to get settled in the evening or maybe in the afternoon, whenever the markets are closing, even an hour prior to that, if I want to take a long or short position, it is possible. But understand one thing, when you take a long position, there has to be someone to take a short position, or another party holding long position wants to make an exit so that you can take a long position. Likewise, say you want to take a short position, there has to be a counterparty who is willing to take long position, or another party holding a short position wants to make an exit out of that contract. This feature makes futures contract as a marketable instrument, whereas forward contract cannot be considered as marketable instruments. So please write up these important points and then I take you to more differences ahead. Let us move ahead and continue with more differences. Forward contracts are unique because only those parties should settle the contract who have originally entered into the contract. On the other hand, futures contract provide flexibility of making entry or exit even before maturity. Due to this flexibility, the parties to the contract keep changing. I have already explained to you this point along with the third point. Next point, forward contracts have risk of default as the performance is not guaranteed, whereas in futures contract there is guarantee of performance as the exchange itself regulates the future contract. Now, this was the initial point because of which we started bringing the futures contract into our discussion. Otherwise, if you can recollect, involvement of that intermediary was the starting point, that there was a risk of default in forward contract. To eliminate that risk, we have introduced the feature of futures contract. Therefore, both of these points you have understood very well already. Just quickly take note of that and then I take you ahead. Let us move ahead and take up more differences. Sixth point, forward contracts may or may not require initial margins to be deposited, whereas depositing initial margin is a prerequisite in any futures contract. Seventh point, forward contracts may provide for actual buying or selling, that is actual delivery, whereas futures contract are settled in cash by receiving or paying the differentials in price necessarily. Let us move ahead and now talk about a very, very important aspect, that is long and short positions. Now, this is something that you have to be extremely careful. I have explained you initially that just for your understanding, long position means the position of a buyer, short position means position of a seller. But that was just an initial one-liner explanation. Let's go into the detail of this. Let us first understand what is meant by long position in the market. Long position arises when you have bullish sentiment. There is something like a currency or a security or a share or a commodity where you have a bullish sentiment that the price of this underlying will go up, or price of this commodity or currency will go up, or the price of the share will go up. And today you are buying that share. You have an expectation that the price will move up, and today you have invested, today you have bought that share. I am talking about not derivatives but the spot market. So you have bought the share in the spot market. You have bought the share and you are holding that share now, waiting for the price to move up, and then you would want to sell it at later stage when the price reaches your target or when the price has gone up, and you make gain out of that. This is what we call as creating a long position in the stock market. That is, buying and holding the stock makes your position a long position. So when you are buying and holding a stock or buying and holding any other security, you have taken a long position in that security. When you are buying and holding a commodity, you have taken a long position in that commodity. As simple as that. But these are spot market transactions where you have actually purchased something, correct? So holding a long position in spot market and holding the long position in futures market are two different things. Please understand that. holding a long position in spot market and holding a long position in futures market are completely different. Both have one common meaning, that is, it indicates the position of the buyer, but how and when it gets settled is a different story altogether. Right now I'm not talking about futures contract at all. I'm talking about the spot market, that is the cash market, the stock market, where you are buying and holding a stock. It gives you a long position. What about short position? Short position is opposite. Now here there is a big catch. So if buying and holding a stock creates a long position, then selling the stock would create a short position. This could be anyone's general understanding. But please understand, when we talk about creating long or creating short position, that creating short position does not mean selling the stock that you already have, because selling the stock that you already have is settlement of your original long position. It's squaring off your long position. Creating a short position means you are selling something that you do not have. Now this could create a confusion initially if you have never heard of what is short selling, and I'm coming to that, so please do not worry about it. Logically, if you have bullish sentiments, what you would do? You would want to buy something now, wait for the price to rise up, and you then sell it at a high price. Then your position is termed as long position. That is clear. What if you have bearish sentiment? The price is expected to decline. In that case, you don't want to buy now. Instead, you would want to sell now and buy later when the price gets reduced. So, when I'm talking about sell now, what exactly we should sell now? Sell now some shares or some underlying or some asset that you already were holding. It is not called as short position. It is not called as short position because it is squaring off your long position. What is meant by short position and short selling? Try to understand. You are expecting that the price of a particular stock is going to decline. So if the price is going to decline, you would want to take advantage of that as well. So you should sell the stock now because right now it is at a high price. Later on you can buy. But how will you sell the stock if you don't have? Selling a stock that you don't have actually means taking a short position. How does this happen? Now over here I would want you to focus on one thing, that there can be two typical types of investors in the market. One which we refer to as active investor, one which we refer to as passive investor. So what is a passive investor? Passive investor makes SIPs. Passive investor will identify that okay, there are 10 good stocks in which I want to invest. On fundamental analysis, that investor has sorted out 10 good stocks in which he wants to invest. And he would want to invest systematically. Every month 1,000 rupees in each stock will be placed. So every month 10,000 rupees getting invested from his pocket. 1,000, 1,000, 1,000 allocated on each stock. He doesn't even bother to look at what is the price because his vision to make investment is real long term, maybe 5 to 10 year time horizon. In that case, fluctuations are going to happen daily, boss. Fluctuations will happen daily. You cannot, keep watching the price all the time to see what is the best opportunity and then you buy the share. If you are doing that, that means you are an active investor, not the passive investor. I am explaining to you how a passive investor would behave. Passive investor believes that the price of the share on a long run will definitely rise. Short run fluctuation, they are not concerned. So they just buy and hold the stock. They just have long positions. Matter over. Active investor on the other side keeps an eye on the stock price movement all the time. As a result, this party is not an investor typically. You can call this party as a trader. We don't call these types of people as investors because they are buying the stock fundamentally to sell it in the near term when they get the price what they have targeted. that means they are not investors, they are stock traders. So stock trader is what we call as active investor. So active investor is keeping an eye on the stock price movements on a regular basis and tracks the price. When the price is low, they want to buy. The moment price is high, they will sell it. Now, what if the price is already high and you don't have that stock? Now you want to still take advantage. One thing could be, someone would say, price is already high, you don't have that stock, wait and watch, no, let the price fall, then you buy. But active investor doesn't do that. Active investor wants to even take the profit from that decline. So how will active investor participate in that decline to make profit for themselves? Very simple. Here comes the role of taking short position in the stock market through what we call as short selling. So simply what you need to do, if you want to sell a share which you don't have, you approach your broker and you tell your broker that, see, I want to take a short position in this share. What broker will do? Broker will approach somebody who is holding a long position, a passive investor typically, who has the share and they don't want to sell the share. So the broker persuades the passive investor, okay, you don't want to sell your share, don't sell it. You just lend your stock. So you lend your stock so that the borrower of the stock will borrow it for some time and then will return back to you afterwards with some charges, typically known as stock lending charges. So these charges along with the stock will be given back to you after a while, maybe 3 months or 6 months time, whatever be the duration decided, and maybe the passive investor agrees. So this active investor borrows the stock from the passive investor and borrowed stock is then sold in the market because the price is currently high. Then the passive investor has done its deed, correct, by lending the stock. Passive investor doesn't need to get involved, but active investor will keep an eye on the stock price movement. When the price declines and the target is reached, this active investor will purchase the quantity of that stock and all the quantity of the stock that was borrowed from the passive investor will be given back along with the charges, stock lending charges. The passive investor is happy. He did not want to sell the stock, wanted to hold the stock, and all the benefits that were accrued while that holding period, maybe dividend or any right issue or any kind of benefit given by the company, that all benefit will come to the passive investor. It cannot be compromised. So passive investor doesn't compromise with any benefit. On top of that, they get stock lending charges as well. So they are happy because they are holding the stock the way they wanted. On top of that, they are getting some income. On the other side, the active investor got an opportunity. They borrowed the stock and they sold it, and when the price declines, they will purchase it again and give it back to the stock lender. Buying a stock means taking a long position. Selling a stock that you don't have means taking a short position. So you understand one thing. Buying a stock creates a long position. Selling that stock is squaring off your long position, correct? And selling a stock that you don't have is called short selling, which is happening through the broker, where a stock lending and stock borrowing activity takes place. I'm going to explain this feature to you in detail, but please be careful about one thing. What we are discussing right now is long and short position in the spot market. Its meaning is little different from taking long and short position in the futures market. Over there, short selling and stock lending and borrowing doesn't come into picture. Over there, it is straightforward. So I'm going to discuss that thing later. Right now, the discussion point is long and short position in the spot market, or we can simply refer to it as a stock market positions. Long position in the stock market, short position in the stock market. How does this come into picture? Let us write some important notes over here based on what we have discussed. A long position indicates a position of buying, that is a position that indicates buying now with the intent to sell later at a higher price. Short position on the other side indicates A position that indicates selling now with the intent to buy later at a lower price. So selling now and buy later is short position, and buying now and sell later is the long position. Let us move ahead, and we are talking about long position in the first order. A position that indicates buying now with the intent to sell later at a higher price. Now this is something that you have already written. Now look at this price movement. Now this particular point over here, this is the position today where we are taking the entry, and this particular point over here is the target. So you understand one thing, currently the price is low and the target price is high. When I am comparing from now to the target, I am not talking about a trend, but I am talking about a sentiment, correct? I am talking about an expectation that the price will move up. Now at this entry point, I will buy the stock, wait for the price to reach up, and there may be temporary fluctuations, but I am waiting till the price reaches the target, and at this point I will sell. Now at the entry, I am making the entry by buying and making the exit by selling. Now this sell is not a short sell, or it is not referred to as short position. This is a big misconception in many students' mind that selling means short position. That is not true. Buying over here, buying and holding the stock was definitely a long position. Selling when the stock has reached its target, or when the price has reached its target, that is what we call as squaring of your long position by taking the opposite position, that is selling the stock that you have purchased earlier. This is long position. So this is the entry point where you started a long position. This is the target point where you have terminated your long position. So starting and termination of long position happens like this. So nowhere short position came in this example, even though over here the sell was involved, but that sell does not resemble a short sell. That means that sell does not resemble a short position, because you are selling something that you already have in your stock. When you sell something that you don't have, that is what we mean by creating short position. So I would want you to just quickly take note of this for your quick understanding, and then I take you ahead. Alright friends, once you are clear with what is long position, let us move ahead and talk about what is short position. A position that indicates selling now with the intent to buy later at a lower price. So now understand one thing, that at this high price, which is the peak point over here, we are trying to make an entry. And we are expecting that the price will go down to this particular point, and this is what we are referring to as target. Now understand one thing, when the entry is at a high price and the target is the low price, what you are going to do? At that high price, are you going to buy and later on sell? Absolutely not. At that high price, you should sell. Now at that high price, when you are selling, a question arises, were you already holding the stock? If yes, then we need to refer back to the case which we have seen a minute earlier, which was the closing of the long position. Selling means closing the long position. Selling does not mean initiating a short position. That is why the terminology used over here, you should be careful. We don't call it sell, we call it sell short or short sell. So short sell indicates selling something that you don't have, and you are going to buy it later to cover up your position, and that is why when you reach the target, you don't call it buy, you call it buy to cover. So understand one thing, when you initiate something, it will be initiated with either buy, or it can be initiated with a short sell. Initiating a position never happens by selling, because when you use the word sell, it indicates that you are selling something that you have already, and that is closure of your long position. It is not beginning of your short position. Beginning of short position means it's a short sell. Short sell means borrowing the stock and selling the borrowed stock. because now you have an obligation that later on you have to give back the stock. So you will have to buy it back to cover your position. That is why it is referred to as buy to cover, not just buy. These terminologies you should be having completely clear into your mind, so that you should never get confused between what is sell and what is short sell, because both are different. So please take note of this as well, and then I take you ahead. Let us move ahead, and now we write something about short selling. Short selling involves selling a stock that you don't own and buying it back later to square the position. A short seller resorts to this strategy because he expects prices to fall and wants to benefit from the fall. In a falling market, this is a good way to make money. Let us move ahead and continue writing further. The term short selling refers to selling a stock that is not owned when the stock price is at high in the market and is expected to decline in future. One can make gains by short selling. This is done by borrowing the stock from someone who holds such stock, thereafter selling the borrowed stock and waiting for the prices to fall. Once the stock price falls, repurchase, that is buy to cover the same stock at such low price and return the borrowed stock to the stock lender along with the stock lending charges. Let us move ahead and now discuss something very, very important, that is long and short positions in futures. As I told you earlier, long and short positions that we have just discussed were long and short positions in the spot market. Now what we are discussing indicates long and short positions in futures. Now in futures contract, taking long short position is not going to be difficult to understand, because here actual buying and selling is not going to happen. So understand one thing, there is say a stock which is having a price of say 300. One party believes that the price will move up and is willing to buy at 300. Another party believes that the price will go down and is willing to sell at 300. So the one that is willing to buy at 300 takes long position, one that is willing to sell will take short position. So short position means agreeing to sell at the contracted price. There is no short selling that gets involved over here, because it is simply a kind of speculative contract where you deposit the initial money and you wait, and if the price has moved exactly as per your perception or as per your sentiment, you have made a gain and you get back more money than what you have deposited. If the price has moved in the adverse direction, then when you get back the money, it will be after deduction of the losses that you have made, and settlement happens. That means taking long position in a futures contract simply means agreeing to buy at the future price, and short position in the futures contract means agreeing to sell at the futures price. So whatever be the contract price, one agrees to buy at that, one agrees to sell at that. The buyer is considered to have a long position in futures, the seller is considered to have a short position in the futures. Actual buying and selling does not happen in the futures contract. So let us write up something about this as well. Long position indicates a position that indicates buying at the contracted price, and short position is a position that indicates selling at the contracted price.